All right, welcome back to Trading Corner. Markets are on the lows. Participants are very short. Are we going to break through and trend down to zero, or are we just going to bounce right back to the middle of this kind of uninteresting range that we've been seeing this year? I think we're going to bounce back. Curious to hear what you think and what your participants are sort of trading with you.
Yeah, so we're actually chatting on a very interesting day. So it's currently expiry. So we're expiring out the front Brent future, which is currently November. So it's giving us an indication kind of where November price barrels are going to, or the forward demand is kind of looking, and the appetite of market participants. So I think last month, to be honest, the last few expiries have been fairly uninteresting. We've definitely been in positive territories the last few. It's the first expiry, we've just had the second window, where we're potentially looking like we might break through flats. So,
On the front spread.
Well, on the cash spread this
Okay.
is. So we're talking about actual physical barrels of November loading crude in the North Sea. So typically, rule of thumb, if the cargoes are trading negative, you'd expect the market slightly weaker.
Yep.
They're trading positive, you are expecting that potentially there's still some backwardation in the physical diff curves, etc. So it's looking like we're heading towards, kind of lower territories, a little bit more bearish. And coupled with that, quite a lot's gone on the last week, right? Geopolitically, but also in the differentials. So last week, I said we have yet failed to break through $1 on the phys-difs for Dated. We finally broke through that range, and we're currently pricing around 60 cents above Dated. So we've had the first big move, 50, 60 cents down on a physical differential. It's quite a sizable move over a week. I think the market was kind of expecting it to happen at some point, but we finally got there. So that is a big deal.
Yeah. So let's say that we physical prices out negative. Do you think that you could see the entire listed Brent spreads curve go into contango, at least for the front few months?
Yeah, I think we could definitely reset a bit on the front. Not necessarily that the Brent spreads will go into contango, because again, we're looking at the forward curve, right? So it will be then looking at where deck barrels are pricing. So let's say we get this huge flush in November, and everything prices really weak. It doesn't necessarily mean that's going to follow through to December. So we could be in an environment where November expiry, we price negative on the cash, but December, January, February, etc., still stay in strong backwardation. But I think what we will see is a lot of the flies and the structure in the front of the curve start to soften. So especially kind of like, Dec Jan Feb Brent, for example, we've already slowly started softening a little bit there. I expect that to continue into the next 1 or 2 weeks.
So kind of a short-term view, not like a permanent ratcheting downwards in the flies.
No, because even still, we need to see where these cargoes are actually going to come in. Again, it's still very much forward-looking, right? So it's giving sentiment. It's not saying actually this is going to be the true demand of November barrels when it comes to actually trading them. So I think, give it a couple more weeks, and we'll see how the market settles. Then we'll be in a position to say, are we going to go into contango and Brent spreads?
Yeah, that narrative really aligns with my view. I think that we could see some sort of jackknife moves lower, but I think they're going to just come right back. And the reason why is I think that you have these tremendous sort of amounts of flex in the system ready to buoy the market if it starts to really sell off, right? Like WAF diffs are already recovering. That's our favorite forward indicator of how barrels way out in the future are going to trade for obvious reasons. It trades the furthest ahead because it's the longest voyage. Margins, they're not falling out of bed. They're starting to look a little bubbly here. They're not ripping either, but okay, fine. So your WAF diffs, your margins are looking good. The market is so short listed futures, and by the market I mean managed money, the weak hands, that on every leg lower you're going to have a lot of buying, a lot of profit taking, right? So it's not like consensus is long and we could unwind a tremendous amount of length and in this sort of sell-off style cascade that you would have seen in a 2020 or 2018. I think there's a lot of buying to the downside. And then finally, like 2025 doesn't look that bearish at these levels. And also, you're starting to see rigs come off, U.S. production's getting a little bit curtailed.
Yeah.
And seasonally, stocks aren't high. They're low for where we should be right now. So
Correct,
there's a
yeah,
lot of flexibility in the system to kind of buy cheap oil. Now, you don't have the SPR buying that you would normally have because it's an election year. So the U.S. is maybe, you could imagine that the incumbent administration is probably incentivized not to buy oil and support the price of oil as you're going into an election. Lower gas prices is, good for the incumbent. So maybe you have the U.S. SPR off the table, maybe, even though they are doing some small clips. China SPR, though, with all that stimulus out east, I think you're going to start to see some buying.
Well, actually, I think for 25 especially, it is quite interesting to start talking about the US. If Trump does win the election, he's kind of already threatened, close to 100% tariffs. Is that going to hit the oil and gas market? This month especially, we really dropped off on US exports into Europe and into Asia, which really helped. It was the basis of why these fiscal differentials haven't yet been able to realign or reset a bit lower, because there wasn't as much US flow coming out and hitting Europe. So it allows these diffs to stay buoyed. Now, if we go into a situation where actually a lot of these high and really strong tariffs will prevent US crude to enter Europe into Cal 25, then I don't know, does it mean we'll be in a perpetual bull market for Europe again?
Yeah, I mean, I think that it's kind of interesting to think about what gigantic tariffs would do to the oil market. I don't think it would affect flat price that much. I think it would obviously impact ARBs and East-Wests and diffs and things like that. I think that Trump is talking tougher than he's actually, I think his bark is going to be a little bit worse than his bite on these tariffs. I don't think he's going to institute 100% tariffs that totally realign and deglobalize the world.
The retaliation,
it would be insane.
It would be phenomenal.
We do have precedent for a Trump presidency in the oil market. He was already president once for 4 years, and living and trading through that, he has a very nuanced approach to oil. Obviously, that's not what comes out on Twitter. Everything on Twitter is all caps, kind of crazy sounding. But he, when prices were crashing during COVID, he was sort of tweeting that OPEC was going to cut before they actually did. He was talking the market up because obviously the oil and gas lobby is a tremendous ally of his, right? They back him more than pretty much any other industry. Meanwhile, when prices were going too high, he was basically attacking OPEC, saying that they're, effectively transferring wealth from the American consumer into the pockets of, Gulf states. And he's very anti-OPEC, anti-collusion. So he's kind of like, he wants it in the middle of the range, right? And I don't think he's very sensitive to it. Whenever oil prices move outside of that middle of the range, he gets loud and he gets aggressive. And we saw some $10 intraday moves when Trump was tweeting during COVID. He crashed the market in 2018 when after going super tough on Iran, he waived the sanctions against them because the oil market was just too tight. He's super dialed into oil. So I don't think we're gonna get I don't think he's gonna implement a policy that takes oil into the stratosphere, because he's going to be focused on it. He's going to open a release valve or two because there's precedent.
But what I think it might do actually for a lot of refiners or people that depend on these exports coming out of the Gulf Coast, if I was an operator there, I'd say forget the US oil. If there's something I can buy, similar price, maybe slightly worse spec or more expensive in the same spec, I would do that all day long. To have the guarantee that you're not going to get hit by any kind of supply disruption is way more important than really, the stake of 10, 20, 30 cents, let's say.
100%.
So it could be interesting. We could see a little bit less ARB movement potentially. If last month's anything to go by, I think the market's held okay. We didn't really get too much aggressive price action. The diffs were fairly stable. So yeah, I think potentially, we might see less of a reliance on US cargoes in the medium term.
Yeah, it's possible. So far, the only tariffs he's announced are on basically Eastern, I think it's manufacturing industries, right? He's not talking about slapping tariffs on all imports.
No, it's just a very easy tool to,
slippery slope, right?
Exactly.
Oh, I don't like Europeans and their oil. F them. Let me just, I see what you're talking about.
And
he wields it. So, It's going to be interesting. Basically my kind of tilt is that he's too sensitive to the oil and gas industry, oil and gas prices, and all of the little constellation of surrounding impacts to actually go after that world. I think he's going to leave it alone. I think his sort of end goal is moderate oil prices, high enough to keep the U.S. industry happy, but low enough to keep the U.S. consumer happy. I think he'll prioritize that, or at least he did last time.
And then just moving on to another big geopolitical headline over the weekend. With Israel, Iran, it's been quite interesting. I mean, we had a lot of headlines out, but you came into the market this morning and typically you'd expect any kind of, war premium to add premium onto flat price or
spreads.
On spreads, flat lines. If anything, I came in, everything felt very weak this morning. So I know we've spoken about very short markets and potentially over positioning on the short side, but the market's not reacting like it is over short, to be honest.
I kind of have two takeaways from that. You're absolutely right. So the first is, if the market's super short and nervous, and then a bunch of Middle East, Iran headlines come out, they should be freaking out and covering their positions and squeezing it. You're totally right. But we've been watching missiles fly back and forth in that region for basically a year now. We're coming up on the 1-year anniversary of that conflict starting. And at this point, the oil market is oversupplied. OPEC is doing their best to keep a floor under it, and traders aren't nervous, right? They're complacent, if anything. They're saying basically what you're seeing is, show me the disruption. Show me a disruption caused by conflict in the Middle East that's going to take out more than OPEC has to basically replace it with. So basically, show me when the Straits of Hormuz get shut. And I guess that's on the table, right? Like let's say that Israel, let's imagine a hypothetical, obviously Israel and Lebanon, or Hezbollah, some paramilitary group in Lebanon trading fire, that doesn't matter for oil prices at all. These are two relatively small economies. They're demand centers. They don't produce anything. But like, if you had Israel basically, just hypothetically, let's say they assassinate the Ayatollah, take out Fordo and Natanz, the two nuclear centers, and then it's just all-out war in the Middle East, and the U.S. gets involved, and the aircraft carriers are, shooting missiles around. Straits of Hormuz probably are not open to maritime traffic at that point, and then you lose, I don't know, a third of the world's oil. So even a heightened probability of that should scare participants, but I think participants are fairly complacent after a year of extremely low volatility. So, let's call it a 2% chance of that happening, maybe goes to 3% on the back of this weekend's headlines. Participants just don't care.
I know, it's quite alarming though that, it was just not bought into at all. I mean, even let's ignore the futures then for a second, even Brent Dubai, I mean, in that kind of situation, you'd expect the Dubai benchmark to really strengthen, just geographically. And I mean, I think it ticked down 10 cents all the way back up after the window. It feels like everyone's positioned and they're just not willing to give it up. And they're not really going to put on more size here until they
We're
get
getting
some
towards the end
signals.
of the year too. It's not when you want to risk a year's worth of P&L. So
no, but you say that, but a lot of the trade houses start their New Year's in October,
That's a good point,
November.
actually.
So it might be that they're going to close out this year into the next month or so a bit quieter, and then get going in November and December. But either way, I personally was very shocked.
I'm not worried about the trading houses positioning though. I'm worried about managed money. Those are the weak hands, right? So the trading houses, we don't know if they're short. It's the managed money who's quite short, right? And they operate on a calendar fiscal year.
That's true.
So my only point is, I basically think that you need to see Israel take out the Ayatollah before that group comes in and says, maybe it's time to start like protecting my downside here.
And that would be, quite a big deal, right? I mean,
It'd be huge,
You don't do anything like that without really understanding what the consequences will be. So,
correct. And Iran's acting dovish. Like every statement that they put out, Israel and Hezbollah are going after each other, but Iran is just calming the oil market. They're saying, this is Hezbollah's fight. They don't need any more resources. It doesn't matter whether you're looking at the front page of the FT or the New York Times. Iran is just out there publicly. Their president gave a speech at the UN. We want peace. Like, these guys do not want to be dragged into a conflict with Israel. and the United States, because they're focused on sort of the long game survival, and they can't. I think if you look at what's going on in the Middle East, I don't think these people think they can survive, a kinetic war with the U.S. and Israel right now at this time. So they're talking very dovishly, and I think that's partly why the oil market's so reassured that this isn't going to just suddenly enter like regional conflagration mode.
Okay.
But short of the straits getting shut, there's nothing that impacts the oil market.
Yeah. Well, yes. Let's see. So yeah, just quickly moving on to the US. So crude, we've been, continually drawing stocks there. It's still looking like it's holding up kind of or a lot of the benchmarks. As I said, we don't have a lot of the grades out of the Gulf Coast hitting Europe or Dubai, which is allowing those benchmarks to hold. On my curve, Dated Brent, we're still seeing predominantly US sell side of a lot of the flow, and we're getting into kind of the time of the year where we should start expecting some crude stocks to start building. So for us, stats this Wednesday and next Wednesday are going to probably start to look, like a bit more of a big deal. If we don't start drawing, I think we can expect the strength to come back into the curve. So as I said, of course, we'll be looking at November expiry today, not necessarily an indication of Jan Brent, for example. Perhaps these crude stocks will be more of an indication of how I'm going to personally position into the front view spreads. The only change we did have last week, though, is we had a lot of, Chinese buying for European crudes, and they were actually helping to keep a lot of the benchmark up. They were the name on a lot of the buy side. That slowly started to flip last week. I'm not too surprised because it kind of coincides with where China were buying up for the SPR, August, September, and October cargoes. The October cycle is pretty much done now. We're moving into November cycle in about a week or so. So it's not too surprising. But the impact it had on the curve and the confidence in the curve were notable. As soon as we saw, for example, one Chinese trade house on the offer side of cargoes in the window, we had a flurry of selling, not only on the crude swaps, but also on the futures.
Interesting.
So if this Chinese strength does not come next month, I think we can all, start to reset a bit lower. The diffs could potentially get down to flat, and that would indicate, to be honest, a bearish market. So let's see. There might be that, though, we sell off enough that someone has appetite at these levels to kind of re-enter into a trade and then rumble. So
I think you're going to find some protagonists eager to squeeze the record
one last
Brent
hurrah.
shorts.
Yeah, of course.
Things aren't, the market is already quite bearish and things aren't that bad. Also, like the risk reward when you're at the lows of the range we've been in for most of the year is to the upside.
Yeah.
Unfortunately.
No, that's true.
So.
And also we have to consider, as we were talking about, a lot of the soft money is kind of more the managed money, the funds, etc. We have to look at all the asset classes that they could potentially position in, and interest rate situation going on. Maybe there's a bit of confusion. I know the market didn't expect the Fed to cut by as much as they did in the last budget. Now, oil probably provides a fairly liquid and low vol market to enter into relative to potentially some other asset classes. So it might be that this positioning, you don't agree?
I don't know about that one.
I mean, the vol this year has been particularly low.
Yeah, but it's not an investment asset class, oil. Basically, the reason why investors buy oil is for the roll yield, and that just went away now that the spreads are all flat or flat-ish, right?
Yeah, but I mean, I do agree, but this whole where to truly put investors' money, not necessarily saying that they want to make a huge return, but they want to keep it safe.
Yeah.
So are bonds the best place to do it when there's so much uncertainty in the markets at the minute?
I think if you're an investor and you're looking at sectors that have maybe underperformed that you think are due for a bounce back, energy is definitely top of mind. However, I think that from an investment perspective, you probably want to deploy it to energy equities, which pay huge dividends and go up in general with the stock market, as opposed to crude oil, which, it's kind of funny. I ran a chart of crude oil denominated in gold instead of the dollar, just because I wanted to filter out inflation and money printing.
Yeah.
We're almost at all-time lows in the price of crude denominated in gold. Like, it's objectively not a great place to park cash
Yeah.
from a non-commodities investment perspective. And that's why you and I, when we run risk and trade, we don't get benchmarked on alpha to the S&P or alpha to something. It's just like dollars come into the account and those are ours. Like, anything better than zero is a win and you get a bonus, right?
Yeah.
That's because our asset class is not expected to generate excess returns. So
Very true. It'll be interesting to see how these positions do end up closing out into the year end
Yeah.
anyway.
definitely.
Yeah, let's see. So lastly, I just want to quickly run through products because
Yes.
we did say at the beginning that margins are starting to pick up. We suggested the crack roll longs
Yeah.
kind of 2-3 weeks in a row. They are finally starting to pick up, which we should expect to see, right? We're going into some turnarounds in Europe, crude softening, hopefully starting to build in the US, etc. And there is some product demand still out there.
I think it's a great time to get long distillates, especially diesel.
Okay, interesting.
You know, all of the things that I watch that would indicate that you're supposed to get long gas oil diesel
Yeah.
across all three regions are flashing bullish.
Okay.
And, you know, we're going into winter. It's a cold one.
Yeah.
Looks pretty interesting, I think, especially from these low levels.
Yeah, I think generally speaking around the floor, we are still quite bullish to crack rolls. But yeah, I think again, each week we're kind of resetting the market, you know, even on flat price, etc. Last week we were trading $74. No one really said much. This week we're trading 71. No one's really saying much. But generally still the overarching view is that into Cal 25, we think crack rolls should still perform. I think if we do dip in crude, I expect not for long, to be honest. I think about three weeks of soft pricing.
It'd be more fun if it went down to $20, but
Yeah, I mean,
just don't think it's going to happen.
to be honest, for me, flat price not necessarily. I more mean the physical diffs and the structure on the dated curve. So really, where these cargoes are actually going to exchange hands, I think we will get a bit of softness, especially if we start building in the US. I think as soon as that builds, it's going to get booked straight on a VLCC and it's going to hit Europe very quickly. So yeah, expecting a bit more arb activity into the next few weeks.
I agree. Cool.
Cool. So long crack rolls still.
Long crack
Let's go.
rolls and be careful on flat price.
Cool.
All right.
All
Until
right.
next week.
See you next week.